So, in this video lesson, then I will discuss the dependence of the foreign exchange rates on the interest rates. So let's consider the pair of US dollar and European euro. So this diagram taken from the Krugman et al. Textbook illustrates the dependence of the foreign exchange market and this kind of market rate of the dollar to euro on the central bank's decisions. So on the left hand side we have in red color the Fed of the USA that can influence the US money market by its money supply and its interest rate. And similarly in Europe, the blue color, we have European Central Bank, ECB, that can influence European money markets by both money supply and then by setting the interest rates. So I should emphasize that for example, in Europe, the mandate of the ECB is to maintain price stability. So the only purpose of the ECB and how ECB sets its interest rates is to keep inflation at this close to its target rate of about 2%. So the purpose of setting the interest rate is not to influence the euro dollar exchange rate, but both in the USA and in Europe, the central banks they mainly care about the inflation and price stability and set the interest rates accordingly. But still, of course, the interest rates have very big importance regarding how the exchange rate between euro and dollar develops. So let's consider then the situation from the investor perspective. So as an investor, you can think about, for example, some investment fund or some kind of multinational corporation. And the question is that should the investor hold US dollars or euros? Or if we think about also that this investor is investing in some kind of interest-bearing assets. So for example, we could think about US government bonds or German government bonds. Both are considered to be fairly low risk or virtually zero risk assets. So then we think about what is this kind of rate of return of the government bond in the US or Germany. So by comparing this kind of expected returns of such kind of government bonds, then the investor should not only take into what is the nominal interest rate of the bond, but also the expected currency appreciation or depreciation is also of importance. So in this equation indicates this kind of formula that a rational investor would consider. But let's look at this table 14.3 taken from Krugman et al. Textbook to illustrate the comparison by 4 numerical cases. So in this table, suppose that the dollar interest rate in all cases is 10%. So suppose that this is this US government bond yield. And then we have euro interest rate is the same of 6% in the first 3 cases, and then we have higher return of 12% in the last case. So then obviously, let's suppose the first case that US bond yield would be 10%, the German bond would yield 6%. And if we suppose that if we do not expect any appreciation or depreciation of the dollar against euro, then obviously the investor would choose the US government bond that has a higher rate of return. In the second case, however, suppose that the expected rate of dollar depreciation against euro is 4%. So in that case, then the investor would get 10% yield from the US government bond. However, if the investor chooses the German government bond, there would be nominal yield of 6%, plus there would be then 4% gain from the appreciation of euro. So euro becomes, in that example, more expensive, and then in the end, the investor would be indifferent between investing in the US bonds or the German bond. In the third case, suppose that then expected depreciation of dollar against euro is even higher, 8%. So this example, case number 3, indicates that even if the nominal bond rate in Germany would be 6% and 10% in USA, a rational investor might still invest in the German bond if the expected rate of dollar depreciation is high enough. So in this case, 8%. So in that case, it would make sense for the investor to choose the German bond. And this would be protecting the investor also from the depreciation of dollar against euro. And finally, in the fourth case, illustrates that also even if now the fourth case, the German bond rate increases to 12%. So even if it is higher than the US government bonds rate, then if then euro is expected to depreciate against dollar. So in other words, if dollar appreciates against euro, then it's not even this kind of higher interest rate is not able to attract investors to buy European bonds, but they would still go for the American bond. So this numerical example and the formula above is proposed to illustrate that how this kind of investment decisions depend not only on this interest rates or the nominal expected rate of return on assets, but also the expected changes in the currency exchange rate also are taken into account by rational investors. So this is also illustrated by this kind of so-called interest parity condition presented on this slide. So we have the formula, and then this illustrative diagram taken from the Krugman et al. Textbook. So if the interest parity condition holds, then the investor would be basically indifferent between investing or holding investments in dollar terms or European terms, or for example holding the US government bonds or German government bonds as this kind of risk-free assets. So how to read this diagram then? So this kind of orange colored vertical line indicates this return from the perspective of an American investor, that what is the return if for example, investor holds the US government bond. So the return for American investor doesn't really depend on the exchange rate if American investor holds American government bond. However, the exchange rate matters if the American investor is holding European bonds. So then this green line then indicates that how this return depends on the exchange rate. So if the exchange rate is and now of course it's not only that what is the initial exchange rate, but what is the expected exchange rate. So in this formula, notice that the superscript indicates the exchange rate at the time of the investment, and then superscript E refers to the expected exchange rate at the end of when this investment matures. So, if, for example, when then this investor sells the bond, so it's what matters is then this expected appreciation or depreciation. So, in point number one, for example, if then the European bond and American bond yield the same rate, so this E1 refers to a situation that there's no change in the currency exchange rate. So case number two refers to a situation where European bond has a lower rate of return. However, the euro is expected to appreciate relative to the dollar, or in other words, dollar is expected to depreciate relative to euro. And similarly, in the third case, if the rate of return of the European bond is higher than that of the American bond, but the dollar is expected to appreciate relative to euro. So then all these cases 1, 2, and 3 are equally good in the sense that the interest parity condition holds. So this kind of analysis can be helpful to then understand what happens, for example, if the US Fed increases the interest rate. So suppose that now then American asset gets a higher return. So now in this diagram, this orange line moves to the right. So there is a rise in the interest rate offered for dollar deposits. So what then happens in the foreign exchange market? Supposing that the European bond rates or interest rates do not change. So in European interest rates do not change. American interest rate increases. So we were initially in the point number one in the equilibrium, but then this kind of change in the interest rate, if nothing else happens, then moves us out of the equilibrium. So the current exchange rate or the previous exchange rate is not anymore in the equilibrium. So then in the foreign exchange market, the exchange rate, the floating exchange rate between USA dollar and euro we need to move to a new equilibrium in point two. And that means that the dollar appreciates relative to euro. So then in the new equilibrium, investors are again equally well off by holding US bonds or European bonds. Now, what happens if on the other hand, the European Central Bank increases its target interest rates, and in the US, the Fed maintains the same interest rate? So then in that situation, the orange vertical line stays the same, but the green line then shifts to the right. So if we were initially in the point one in the equilibrium, then in the new equilibrium, if the interest rates in Europe increase, then we need to have that euro appreciates relative to dollar, and then we have a new equilibrium in number two, so that again investors are equally well off by investing in Europe or the US, and then this change in the currency exchange rate automatically then brings again balance in this situation. So to summarize, then all else equal, an increase in the interest paid on deposits of a currency causes that currency to appreciate against foreign currencies. So, and of course, conversely, a decrease in the interest rate then causes the currency to depreciate against foreign currencies. So, interestingly, this of course, for example, when the European Central Bank announces of for example change in the interest rate then typically, of course, also the foreign exchange rate responds to some extent. But notice that this kind of analysis is based on the expected appreciation or depreciation of the currency. So sometimes these expectations then take some time before they react to, for example, announcement of the central banks. Some investors, of course, react instantaneously, but then sometimes also the exchange rates adjust with some delay, because also remember that there were different types of participants to the foreign exchange markets, including different types of mutual funds and pension funds and multinational companies. So sometimes the response from the domestic money market to this foreign exchange market occurs with some delay, and then of course a rational investor can also then benefit from this kind of delays. So in the next theme, we will then move on to consider financial globalization and some interesting topics related to that theme. See you then.